Hi, everyone. So, welcome to the stream today. Happy New Year to you. I believe that you had a beautiful end of year and your year has started gradually well. Today, being 2nd of January, we are still in the very beginning of the year. And I believe that you have some plans in place to ensure that you put yourself in the position to get the best out of the year, number one. And most importantly, make sure you become successful and achieve your goals this year. I'm praying with you that everything that is on your heart, God will help you and supply you with all your needs according to his riches in Christ, so that at the end of the day, glory will be to God. Thanks for joining us on the stream today. And we are getting ourselves excited into some of the practice questions that we are looking at. So in the previous session, we started solving some questions on the accounting standards and ethics. Today, we're going to be continuing with that same discussion and going through some of the accounting standards that you need to understand. Also, if there are any questions you have, something you want me to share my thought on, don't hesitate. Put it in the comment section or the chat. I want to hear from you. Remember to share the video. Let us reach as many students as possible in the stream today or on the stream today. Let me bring up my screen quickly and let's get excited into the discussion for the day. Having some lag a little bit, I don't know. So let's see. Give me a moment. Okay, so let's go. So we are coming in and we want to look at some IFRSs in the discussion today. We're going to be looking at IAS 36, impairment of assets, IAS 38, intangible assets, share some thoughts on IFRS 15, revenue from contract with customers, and other issues that we need to understand. And we are going into financial reporting, ICAG, July 2024 past question. Financial reporting, ICAG, July 2024 past question. And we want to use that as a guinea pig to walk ourselves through some of the key issues we need to understand in respect of these accounting standards. So you can download this question on the ICAG website. It's a public document available. You can just go to the ICAG website and boom, you'll be able to have access to it. So we go to question 2, which is on the accounting standards, to look at some few things there. Because if you remember, we said when it comes to financial reporting, we're going to be having 20 marks dedicated question on the accounting standards. And so it's important we familiarize ourselves with the accounting standards, paying attention to the various core issues that we need to understand. So let's go straight up into the discussion. Question 2, ICAG, July 2024, financial reporting, past question. The first question we want to look at is IAS 36, impairment of assets. And it is a 6 marks question. 1.8 times 6 means we are using approximately 11 minutes to work here. So within 11 minutes, we should be able to finish with this based on the workflow. So let's see what we got here. A, Someni Limited, Someni, is undertaking an impairment test for one of its cash-generating units, which has a 3-year horizon. Someni has prepared the following list of budgeted cash flows for the purpose of calculating value in use over the next 3 years, 31st December 2024 year end onwards, using 31st December 2023 prices. So we see the data December 2024, December 2025, December 2026. We are told that Someni's weighted average real cost of capital adjusted for the effect of inflation is 8% per annum. That's very important to us there. All Somanese cash generating units exhibit similar risks. Assume all cash flows occur at the end of each year. So this is what we have available in respect of this particular question, IAS 36, impairment of assets, and we are calculating value in use. Now, if you remember from IAS 36, an asset is said to have suffered an impairment when the carrying amount of the asset exceeds the recoverable amount of the asset. Recoverable amount of an asset is the higher of value in use and then the fair value less cost to sell. In this question, all we are asked to do is to calculate the value in use. Now, value in use is simply the present value of the cash flows to be generated from the continuous usage of the asset over its remaining useful life. So if we don't sell the asset and we continue to use it in the day-to-day running of the organization, how much are we likely to generate from that asset? That is what value in use is. Now, because we are estimating for future periods, always the cash flow must be discounted into present value so that we can then get our value in use in today's term. Then we can take that as the recoverable amount as well for the period under review. So let's look at the data we have here again. We are working for the year ended 31st December 2023. Now, value in use is future cash flows. So if our year ended is 31st December 2023, then we'll start taking cash flows from 2024, 2025, 2026 as indicated in the flow here. Now, it's always important for you to be mindful of that because sometimes the examiner can bait you, right? The examiner can put something down that if you're not careful could mislead you. So a scenario will be the examiner could still bring the 31st December 2023 figures as well. Then if you're not careful, you use all of them. But if you're in 31st December 2023, it means you need 2024, 2025, 2026 in that order as projected or provided for in this question here. So we're going to present the same way they have presented. So question 2A, 31st December 2024, 2025, 2026. December 2025, 31st December 2026. Okay. So we slash in our currency sign, Ghana cedi 3 zeros up. Then you got to be careful here. First, we have cash sales. Now, remember, this is a cash generating unit. So a cash generating unit can be a group of assets which together gives us cash flows or can independently generate cash flow. A branch of a business can be a cash generating unit. A segment of a business can be a cash generating unit. So it depends on where we are going, but it all can be there. So first, cash sales will come because that's revenue. Let's see. Cash from sales. Okay. So how much do we have respectively? 2875, 3000, 3000, 2250. Stay with me carefully. Then the next item is cash paid to acquired inventories. Cash paid to acquired inventories. That's a cost we are going to be incurring. So cash paid to acquire inventories. How much do we have? 1437.5. That's a cost, so we're going to take it out. 1005 in the second column and 1125 in the third column. So the styling of the question here is what is informing us on how to approach the question. Next, wages and salaries cost. Yeah, because if you are generating sales, wages and salary has to be paid. So we bring that. So wages and salaries cost. How much we got? 562.5. I think it's 562.5 throughout. So we take it out respectively. Next, interest paid on loan. Be careful here. That cannot be included in arriving at the net cash flow from the from the cash generating unit in calculating the value in use. Why is that a case? Because the effect of interest will be included in the discount factor that will be used. Do you get the idea? So the effect of the interest will be included in the discount factor that is used. Because remember, this is like a normal present value issue we are doing. And if you are doing normal NPV issues, interest you pay doesn't form part of the cash flows that are going to be coming in, because the effect of the interest cost will be included in the discounting factor that you are going to use. So that is not going to be working there. Next one, tax paid. That will also not be considered because, again, taxes paid varies and that will not be included in our workflow here. Next one, payment of restructuring cost provided for at 31st December 2023. Okay. Restructuring cost. Now, in accordance with IAS 37, they have already provided for the restructuring cost. So since they have provided for the restructuring cost, that cannot feed into the calculation because they have provided for it already for the year ended 31st December 2023. So it cannot come in because it has already been charged against the year ended 31st December 2023's financial statement. So it wouldn't have any effect again. So that will also not be brought. Then disposal proceeds. That's important because when we are dealing with cash generating units, impairment testing, value in use, the proceeds from the disposal at the end of the economic useful life of the asset must be brought. So disposal proceeds. And that always comes at the end of the year, and that's 625. And that is an inflow for us there. So that is what we must understand in respect of this. So 3 things are not coming in. The interest we paid on loan will not come because the effect of the interest would have been adjusted for in arriving at the discount factor that we are going to be using, the cost of capital we are going to be using. Then the tax paid, also not to be considered. Then the payment of the restructuring cost has already been provided for, so has no implication or no effect on the future cash flows from the cash generating units that we are using or looking at. So that is what you must understand there in respect of this particular one. But I need you to pay attention carefully here. You are given real cost of capital, okay? And we are also giving the cash flows using 31st December prices. It means the cash flows are also in real terms. So we can just use the rate and go away. Because remember, again, from your financial management class, you learned this. In your management accounting class, you learned this. And you know that when we are dealing with discounting factors, real cash flow must be discounted using real cost of capital. Nominal cash flows must be discounted using nominal cost of capital. And you must know all of those things because although you are in financial reporting, the question could be structured in such a way that you will apply it or you may have to call on that. But here we don't need any issue like that. Just wanted to draw your attention on it. So let's get a net cash flows coming in arithmetically. 2875 minus 1437.5 minus 562.5, and that is 875. No, 875 Next one, 3,000 minus 1,005 minus 562.5. And I'm getting 937.5. Okay, 937.5. Then the last one, 2250 minus 1125 minus 562.5 plus 625. And that is giving me an amount of 1187.5. So that is going to be our net cash flows we are getting. But this is in present terms, so we need to discount that. This is in the future value we are getting, so we need to discount that into present value. So discount factor at 8%, right? So we can calculate this easily. You know that 1 over 1 plus R. Okay, 1 over 1 plus R exponent n. Okay, that can also be represented as 1 plus R exponent negative n, whichever way you want to go. So 8%, if you are punching 1 over 1.08 exponent 1, 1.08 exponent 2, 1.08 exponent 3. That's how you get your discount factor there. So 1 over 1.08 bracket close. Exponent, okay, that's the first year, 0.9. You can decide to work to 3 decimal places or 2 decimal places. So 0.93, I'm doing 2 decimal places. Exponent 2, that's 0.86. Then the final one, exponent 3, 0.79. So working to 2 decimal places, you multiply that so that you can get a discounted cash flows, which becomes the value in use. So we add it up, we multiply, 875 times 0.93. That's 813.75 or 0.75. 937.5 times 0.86. That's 806.25. Then 1187.5 times 0.79. That is 938.13. So that's a discounted cash flow, but we need to add all of them up to get a value in use. So the value in use will be equal to, so we add them up, plus 806.25 plus 813.75, and that is 2558.13. So this is the value in use calculation for this question. 6 marks to be done in 11 minutes. And that is the beauty of the accounting standards, that the examiner can just take a portion of the standard and ask you a question about it. So it's an impairment question, but the examiner just said, calculate value in use. You are not testing for impairment. You are not doing anything at the end of the day. Just give me value in use. 6 marks. I'm seeing some chats coming in. If there are any questions you have, please put it in the comment section or the chat for me. Let's see if I can have this coming up. So, welcome, sir. We are watching from Bauchi State, Nigeria. Okay, Abdullah, thanks for joining. Timothy said, good evening, sir. Good evening. I thought we would start from exponent 0. You thought you start from what? Yeah, the first year we won't do any exponent. So you just punch that directly. Okay? Timothy. The first year you don't do anything. So you just punch that directly. That's why it's 1 over 1.08. So you punch that directly and then you go away. Okay? You punch that directly and you go away. Any questions, please put it in the comment section or the chat for me. Any questions, and also share the video, okay? If you are getting values, please share the video on your WhatsApp groups, Telegram groups, wherever you are, just share. Let's get to as many students as possible joining the stream and watching the playback as well as we proceed in the discussion. So, Timothy, I hope you are okay with the comments about the exponent issue you raised. But that is the idea here and what you need to understand. Okay. Now, remember that if you want access to more questions like this, right, solved covering the various areas of the syllabus, from the standards, consolidation, single entity financial statement, then governance, everything in the syllabus, then you can get access to our practice question courses, dedicated practice questions. That way, you get the opportunity to walk through the syllabus, lectures, solved, accessible in the mobile application as well as on our website. So you can visit our website and enroll in the dedicated practice question course. Maybe you are somebody who is doing a recit for the paper. It means that you just have to identify the areas that you have challenge with. Then you expose yourself to as many questions as possible. Or this is the first time you are even writing the paper and you need more exposure to questions. Okay, the practice question courses will really help you to go through, and we have lecture videos covering each of the standards, not just one question, multiple questions across all areas of the syllabus, so you can prepare well and pass the examination. So head on to our website to check it out, or send us a message on WhatsApp, and my assistant will help you so you can enroll and get access to that as well. Then it can help you to prepare well for the examination and pass the exam. So Timothy said, okay, so you understand. That's good there. That's good. Ako said, good evening, sir. I am watching from Mauguri. Sorry if I don't mention that right. Nigeria. Great job, sir. Thank you, Ako Boye. I believe that I did not mispronounce your name, if I can say that. Right, so that's the first question. IAS 38. IAS 36, impairment of assets. Let's look and go into another question, still in this set of questions, but let's go to question number 5. Okay, let's go to question number 5, because there is another question there that I want us to look at. Question 5B. Question 5B. And this is, no, C rather, not B, C. This is on, let's see. Determine the item that should be expensed and capitalized, and the item that should be capitalized on the initial recognition in the financial statement of Kwanzima. Okay, in the financial statement of Kwanzima, and this is 5 marks, so you are working with 9 minutes. Am I right? Yeah, 9 minutes for the most part in that case. I think I'm seeing a comment coming up. Let me address that quickly. There we go. Kwesi said, let's see. Can I bring that? Yeah, Kwesi said, is this different from intangible assets and impairment? Yes, Kwesi, intangible assets is IAS 38. Impairment is IAS 36. Do you get it? And the question we just solved is under impairment, just a part of impairment. Because we said an asset has suffered an impairment if the recoverable amount, or when the recoverable amount of the asset is less than the carrying amount. So the amount we are carrying the asset in our books is greater than the recoverable amount, then the asset has suffered an impairment. But how do we get the impairment? We get to the impairment by calculating the recoverable amount. The recoverable amount is the higher of value in use and then fair value less cost to sell. So this question is just asking us to calculate the value in use. That's the context of this question. So yes, it is under IAS 36, impairment of assets, but we are just a portion of it. Calculate value in use. That is the issue that you must understand there. Let me know if that makes sense to you, Kwesi. May I know why you ignored the tax in this calculation? Yeah, we mentioned that the reason we are taking out the tax effect is also because the amount of tax payable varies from year to year. This is not project appraisal. This is on a cash generating unit. And so for that reason, the tax will be accounted for in the respective years that they are incurred, not just an estimate of how much tax we think we are going to be paying based on the future operations of the entity from a business perspective. So future operations or future expectation of amount of tax we will pay from our core activities will not feed into the calculation of the value in use, because other issues about taxes in IAS 12 would have been accounted for in the real financial statement, so that will not feed into the calculation of the value in use. That is why we are not considering the taxes that are expected to be paid. Does that make sense? So, Boyi, let me know if that is clear to you. Please, which year exam is this? This is ICA July 2024 financial reporting. Past question. So ICAG July 2024 financial reporting. That is what we are looking at. SWOT Kotoka. Hey, please, having access to practice questions on the app, is it free? No, our full practice question courses are paid courses. Okay, it's paid course and it's 599 Ghana cedis, 599 Ghana cedis. So it's not free. That one is paid for because you get access to the questions on all of the standards, all of the topics, multiple questions covering all of those areas, accessible in the mobile application as well as on our website. And you get access to both the questions and the solution, everything together. So it's a whole package on its own that you can get access to. So for the practice question course, it's not free. It is a paid course available that you can get access to. All right? So that is what you must understand there. SWOT Kotoka, I believe, is the Kotoka International Airport. Forgive me, okay? Let's go. So let's come to question number 5 here. Kwanzaa. We are asked to determine which of the items should be expensed and the items that should be capitalized. Okay? Which of the items the entity should expense and which of the items the entity must. So let's see. Kwanzaa Limited, Kwanzaa, after its incorporation, incurred various costs. Below are some of the costs incurred in 2023 when setting up. Okay. When setting up. Okay, let's go. Let's see what we got here. 750 Ghana cedis to register the domain name that a company will use for its brand. Okay. Payment for a domain name is a capital expenditure. So that is an intangible asset in accordance with IAS 38. So as per IAS 38, the domain name will be capitalized. So maybe let me present this way. Kwanzaa Limited. So note I, what do we say? The 750, the 750 Ghana cedis paid to register the domain. Did they say domain name or just domain? Okay, the domain name must be capitalized. Must be capitalized in accordance with IAS 38, intangible assets. Now, I hope you know what a domain name is. So, whatever your name.com. So, NhyiraPremium.com. That's the domain name. Kukua.com. That's domain name. Are you getting it? Suotkotoka.org. That's domain name. So, when an entity pays money for the domain name, that is a capital expenditure. It is an intangible asset because that cost will be capitalized. It will be capitalized. So that's what you must understand there. Now, one of the things you must also understand is that sometimes it's not that the question is difficult, but you don't even know what the question is about, the nature of the industry. That sometimes can really make you have challenges in understanding and appreciating the question. So expose yourself to industries, sectors, so that you can familiarize yourself with some terminologies, can it be, and things. Do you understand? Note 2, let's go. Cost incurred internally to design and develop content for the website amounts to 7,500 and 2,550 Ghana cedis, respectively. Stay with me. Stay with me. So, we are supposed to now find out the design cost. Should it be capitalized? The content development cost, should it be capitalized? Now, this is what we do. The cost of designing the website, that must be capitalized. But the cost incurred to develop the contents for the website, that must be expensed or written off in the profit or loss account. Do you get the idea? Because when you buy the domain, that's all, you are going to do hosting. Then we now have to design the website so that when someone visits the website, like when you go to our website, everything you see there, that is the design cost of the UI, the user interface. The content development is what you see display on the site. And normally that is part of marketing cost. So per IAS 38, the content development for the website is always written off. Did you get that? So you have to be careful here because the content for the website is regarded as marketing expenses and hence must be written off. So the 7,500 Ghana cedis spent on the design of the website must be capitalized. However, the content development cost, how much is it? 2,550. Content development cost of 2,550 Ghana cedis must be written off in the profit or loss. as it is treated as a marketing cost. Or let's say marketing expense as per IAS 38. Now, let me say something here quickly. This content development for the website cost here, this is different from if it is a typical streaming platform like Netflix. So if we are dealing with Netflix, then content development for Netflix is going to shoot a whole movie. And that will be 60 million budget, 200 million budget. That one, it will be capitalized. Do you get the idea here? So you have to be careful about the context of the question and what we are doing here in respect of that. In a typical, like the streaming environment, as I said, maybe Apple TV or Netflix or Amazon Prime, if they talk about content development, that will be capital expenditure. So the 60 million, 20 million, 120 million, or $200 million that they spend on a movie, on a series, on a show, that will be capitalized. You can't write it off. Aside that environment, content development for regular business website will be treated as marketing expenses and written off. So you have to be careful about the context of the question and the way the standard will apply. If not, you're going to have a lot of problems in that regard. Okay, so I'm seeing a question coming up in respect of this. Let's see if I can address that. Timothy said, so Nhyira, we don't add the various IASs. Huh? We don't add the various IASs. Would it affect us? Like how? Oh, like as per IAS, this, as per IAS, that. There is a professional way sometimes that a marking scheme is structured. So a question of this nature, it will be prudent for you to refer the accounting standard that is guiding you to say it should be capitalized or it should be written off. If you don't, the examiner can punish you, take 1/3 away from the marks, because you cannot just write and say, oh, the domain registration capitalized. Okay. On what grounds? Do you get the idea, Timothy? So on what grounds? That's the idea. So the grounds is your attachment of the standards and explaining to the examiner. So that forms part of the professional presentation in the exam hall. So that's something that you need to understand there. But sir, development cost is always capitalized, or be careful. Be careful. An entity, in the context of this question, the content development, be careful here because this is a website. So they have bought a domain and they are developing content for the website. So in that environment, we say that the content development cost is marketing expenses. Because they would design, graphic designers would design some things, people will write some content display on the website, all are regarded as marketing expenses. And the content on the website may change from time to time, depending on what the entity is seeking to sell or do at a given time. So in the context of this question, the content development cost will be written off. But generally, like you are saying, development costs will be capitalized if we are in a product development environment. So let's say that we are doing a research to produce a calculator, or we are doing a research to manufacture or bring a new water in place, or we want to bring in a microphone or something like that. And you are spending money to develop the prototype, the testing, and all of those health issues about the products that we are working on. In that environment, then the expenses or the development cost may be capitalized subject to meeting the capitalization rule, which is sector. Meaning it's a separately identified project. The cost can be estimated reliably. It has a commercial value. It is technically feasible. On the overall, it is profitable, and the entity has resources to complete it. So it's about context of the question and how you approach it. Do you get the idea, Timothy? So that's what's happening here. It's about context. In this question, it is marketing expenses. You can't capitalize it. But as I said, if it was a movie, a streaming platform, and that content development cost relates to shooting a series, shooting a show, then you cannot just say, oh, let's write it off. Majority or greater portion of that cost may be capitalized and amortized over the estimated life of the show, which again sometimes is difficult to determine. But in the typical manufacturing, pharmaceutical industry, developing product, prototype, and those things, development cost will be capitalized if the sector principle is met. So, Timothy, that's the clarity that you must understand in respect of that. Let me know if you get that. Sword said, okay, is it one-time payment? Yes, it's a one-time payment, and you get access to the content for the period under review. So it's a one-time payment. You can send us a message on WhatsApp if you have any other information that you want to seek clarity on. My assistant will help you so you can complete the enrollment wherever you are. Okay, so it's a one-time payment for the practice question courses so that you can prepare well for the examination. Timothy said, please clear. Okay, that's good. So that's point number 2, IAS 38. So you see that it's just a 5 marks question. So you got to be careful. Speed and accuracy is key, and then application of the principles in the manner that is required is also important here. III, 2,250 Ghana cedis, legal and administrative cost to set up and register the company. Legal and administrative cost to set up and register the company. Okay. Legal and administrative costs, it's okay. We can write it off. Okay? Expensed in the profit or loss. I'm not going to write English for this, but you get a concept now. I've written 2 for you. So now you get a flow. So you can write it out. So this will be expense because administrative expenses we incur there, we will just take it out and put it in the profit or loss account. Okay, as part of the cost that we are incurring for the period. Again, there is a trap here. And the trap here is for you to say that, oh, okay, the legal cost was incurred because of the website or because of registering the company. And so let's include that in the initial cost of the asset. If it was just legal, then maybe it will be acceptable that you can just, because the legal and professional cost incurred in acquisition of assets, that one will be included in the cost of the asset. But administrative costs, those ones are normally going to be incurred either way. So that is why this will be expensed and not capitalized. Note IV 4. 4,500 on printing brochures presenting the company's concept and product. Okay. That's not a miracle, right? That's marketing cost. So you expense that as well. Okay. You print brochures and you share it around. Hey, this is our website. Oh, this is what we do. If you need this, come. It's expenses, marketing expenses. You don't capitalize that. Oh, we printed a lot so that we can share it over a long period of time. We don't care. It is marketing expenses. You cannot capitalize it. You write it off. Then the vein, note vein, it says, 18,000 Ghana cedis sending off on external computer training costs. Okay. Training of employees, we don't care. That's also going to be expense in the profit or loss account. Simple. So training of employees, that's an expense. Will be written off in the profit or loss account. Under no circumstance, 99.9% of the time, will training expense be capitalized. It's always going to be expensed in the profit or loss account. Now, this is where there is another argument here. People will say that, hey, Nhyira, without training the staff, they can't use the product. And sometimes the question will say, oh, training employees to understand how to use the product and demonstrate it to customers as well. We don't care. Because the concept here is the asset ready for its intended use? Will the asset serve its purpose with or without the training? The answer is yes. The asset is there. It is ready. So the training cost is non-attributable cost to the asset. Whether you train the employees or you don't train them, the asset is ready for its intended use. So do not touch it. And that is the idea about that. And that's what you must understand there in respect of that. So this is question 5. So technically, this Kwanzaa question is calling on a mixture of things, but focusing largely on IAS 38, intangible assets. That's all. We are done. 5 marks. Any other questions? Everybody good? That is Kwanzaa Limited and what we can do here. Okay. So let's go. So that was question 5, IAS 38, intangible asset. Again, you see that this question is not difficult at all, is it? It's not difficult. But you see, if you don't understand the standards well, and you haven't exposed yourself to as many questions as possible, you can screw up a lot here. But look at this question. It's simple. You can literally close your eyes and do it, and you'll be good. And you'll be good. All right? So exposure to questions will be key. It doesn't matter how you think you understand the thing. You need to expose yourself to a lot of questions. And that's going to be helping you. All right? And the way you deal with practice questions is not just, looking at a question and go and look at the solution. Because sometimes you look at a question and the solution and you don't understand why they arrived at the answers that they arrived at. So sometimes using the past questions just by yourself is a bit problematic. Again, that is why we provide you that guidelines on the practice question course. And we are going through questions from ACCA, SEMA, ICA, ICAG. So the questions are coming from various sources, crystallizing the principles. And that increases your understanding of the topics well and position you to really pass the examination. Let's go back to question 2, because there are other things that I want to draw your attention on in question 2. So let's go to question 2C. Question 2C. 5 marks. It says, in accordance with IFRS 15, explain the 5 steps to be applied in the recognition of revenue. IFRS 15, revenue from contracts with customers. Right? Revenue from contracts with customers. Let's read a preamble. IFRS 15, revenue from contracts with customers, establishes the principles that an entity should apply, when reporting information about the nature, amount, timing, and uncertainty of revenue and cash flows from a contract with a customer. According to IFRS 15, an entity recognizes revenue to depict the transfer of promised goods or services to the customer in an amount that reflects the consideration to which the entity expects to be entitled in exchange for those goods or services. Okay. The answer to the question is actually in the preamble. But you just have to know and be able to do it. So in accordance with IFRS 15, we have the 5-step framework for revenue recognition. So let me go through that with you quickly, the 5-step framework. So in the context of this question, you are writing English. No calculations here. You are writing English. And it is one of the challenges of many of you. Immediately the examiner puts you in a place where you have to write English, you have to explain things, then you are crippled because your English is not good. You cannot express yourself well on paper. So in addition to learning the things you are learning, doing the calculation, note that every calculation in financial reporting, corporate reporting can be asked as a written question. So in addition to learning the calculation punching, work on your expression. Work on the way you structure out your answers so you can optimize your chances of passing the examination. Because if you look at this question we solved, the first question we solved, it was a calculation question. Directly, you could go straight up, do your calculation, boom. But the second question, we are writing English because there's no calculation to be done. So how you express yourself is also crucial to your ability for your ability to be able to pass the examination. So what is the 5-step framework? Let's look at them quickly here. And I'm coming in from my book on the subjects, okay? IFRS 15, revenue from contract with customers. This is the corporate reporting book, page 275 of the book. So IFRS 15 requires that before we recognize revenue, we must go through 5 steps. Technically, the customer. Is there a contract with the customer? That's the starting point. So a contract is with a customer if the contract has been approved by the parties to the contract, meaning the entity and the customer in question. 2, each party in the relationship in relation to the goods or service to be transferred can be identified. So we can identify who the seller is, who the buyer or the beneficiary is. The payment terms for the goods to be transferred can be identified. How are you going to pay me? Is it paying now or paying in installments or paying at some time in the future? That is there. And then the contract has commercial substance. Very important. It means there is a price on it to be paid. And then it is probable that the consideration to which the entity is entitled to in exchange for the goods and services will be collected. So if someone comes to me, all right, someone comes to me. So let's say I have a friend, Kukwa, comes to me and Kukwa said, hey, Nhyira, I want you to teach me. I'm going to write ACCA. And I said, okay, I'm going to teach you. You're going to write the ACCA and you're going to pass. Then we agree, okay, I'm going to meet Kukwa 12 times. And we're going to solve questions, blah, 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 blah. Okay. How much is Kukwa going to pay me? Oh, Kukwa will not pay anything because Kukwa is my friend, so she won't pay anything. So it's free, pro bono, like the lawyers will say. Okay? It's pro bono. This one, there's no money coming from there. What does that mean? It means that although I know what I'm going to be doing, we are not getting any money from this deal. So in the first place, there is no revenue to be recognized here because there's no consideration here and we won't get anything from the deal. So this deal cannot even come to the books at all. So the first thing we are asking ourselves is there a contract with the customer? But if it is not a pro bono deal and the deal has been arranged, so I'm going to teach Kukwa 12 times and I'm going to give her books. So teach her 12 times, give her books. She's going to get access to our practice question courses and other content. She's going to have a live mentorship session with me in addition to the regular classes and all that. And in exchange, she's going to pay, let's say, 6,000 Ghana cedi for that. Then we are in business. Do you get the idea? Then we can say, oh, there is a contract with the customer. That's the idea there. Then we go to step number 2. Identify the performance obligation in the contract. The performance obligation is what our entity is going to do in exchange for the consideration. So from my example here, my performance obligation is teaching 12 times, giving her books. She's getting access to our content over the period, and then live mentorship session. So these are called performance obligation. What the entity is going to do either now or over the terms of the contract. Now, it is important for you to understand this because sometimes some performance obligations can be satisfied at the date that we arrange or agree on the contract, and other times it could be over the period of the contract. I'll come back to that in a moment. But that is step number 2, performance obligation. What are we doing under the contract? That's the second point or second step. Step number 3 is to determine the transaction price. The transaction price simply means the amount of consideration the entity is going to receive for the work being done. And so in the context of my example here, Kukwa is paying me 6,000 Ghana cedis. That becomes the transaction price. That becomes the transaction price. Now, we can have another example where you go buy a car. So you go to whichever car company, Zonda Ghana, okay? So you go to Zonda Ghana and say, hey, you want one of their new electric vehicles, okay? So you go there and say, hey, I want one of your new electric vehicles. Then, okay. Zonda Ghana said, please, this is just an example, okay? Zonda Ghana said, oh, our electric vehicle is whatever. Let's say 125,000 Ghana cedis. Okay. Then you sign a check. Boom. 125,000 cedis to Zonda Ghana. Then you get your car. In that state, the performance obligation, Zonda Ghana is giving you the car for how much? 125,000. And the contract ends there. But there are some arrangements where the performance obligation will be both this now and in the future. So for instance, let's say that we are dealing with telecommunication networks. They don't do it in Ghana here, but let me use it anyway. In other jurisdictions, US, UK, let's say that I want the iPhone 17 Pro Max. Okay? So I want the iPhone 17 Pro Max. Now, MTN Ghana can say that, okay, come for a free iPhone 17 Pro Max, but you have to sign a contract with us and use MTN for 36 months. Do you get the idea? Stay with me carefully. So MTN Ghana is marketing, and this is what goes on in UK, US, and other developed economy. This country there, they don't have some of these things here. I don't know why. You get free iPhone, just sign a contract that you will be with us for the next 36 months. So you realize that in this case, the day you will sign the contract with MTN, you will get the phone. So that is one performance obligation at the date of the contract. Then over 36 months, MTN is going to give you what? Internet services. Then you're going to pay that monthly bill. That is what we mean by transaction price and performance obligation. Now, you got to be careful here. The free iPhone that the MTN will give, please, it's an example. It's not available in Ghana yet. The free iPhone that the MTN will give, they can't treat it as a marketing expenses. In IAS 18, the previous revenue standard, it would have been marketing expense. But in IFRS 15, the free iPhone given is part of the performance obligations. That's the deal there. Now, we then go to step number 5. We recognize revenue. Step 4. Allocate the transaction price to the performance obligation in the contract. This is where there are multiple performance obligations in the contract. Then in that case, we must allocate. So let me give you a simple example. So let's say that we are dealing with this contract. So now we have Ohima going to MTN Ghana and saying that for their promotion. So the deal is that you get a free iPhone 17 Pro Max. You sign a 36-month internet contract. And then you are going to pay every month, let's say, 250 Ghana cedis. Stay with me. So for all these, 250 times 36 months, it means technically MTN is going to get 9,000 Ghana cedis. So that could be referred to as the transaction price. The total amount over the 36 months, 9,000 Ghana cedis. Stay with me here. But MTN is doing two things in this contract: giving you the phone and then the internet service. So we must allocate the 9,000 to the phone and then the internet services using their standalone prices. So if MTN was selling the iPhone, okay, if the MTN was selling just the iPhone 17 Pro Max, how much would they have sold it for? Let's say that, okay, they may sell it for let's say 8,500. Okay, just an example, don't worry, some of you. Then the internet service, if it wasn't this deal, the internet service would have been 125 Ghana cedis. Okay, 125 Ghana cedis. So in total, how much would MTN have received if they had sold these separately? So the internet will be 125 times 36, and that is 4,500. So for 36 months, that will be 4,500. You add it to the 8,500, that will be 13,000 Ghana cedis. So if MTN was selling the iPhone separately, offering the internet services separately, that would have been 13,000 Ghana cedis. But how much is MTN getting under this deal with Ohima? MTN is getting just 9,000 Ghana cedis. So we then have to allocate. So how much of the 9,000 must we charge to the iPhone? How much must be charged to should we charge to the internet services? That is the step number 4. So it's very simple. We can just say iPhone, and that'll be 8,500 over the total 13,000 times the transaction price, which is 9,000 Ghana cedis. We do the same thing for the internet services. And that would have been 4,500 over 13,000 times 9,000. So we punch that out quickly. What do we have? Let's see. 8,500 divided by 13,000 times 9,000. So the phone will be 5,884, maybe 85. Then the internet service, 4,500, will be 3,115 cedis. So that is the idea about step number 4. We allocate the transaction price to the performance obligation using their standalone prices. Now, remember, in the context of the question we are looking at, you are writing and explaining these things. But I'm in class, so that's why I'm going ahead to teach the standard literally. Then step number 5 is the last one. Recognize revenue as or when performance obligation is satisfied. And this is where the rule that I mentioned earlier will apply. That some of the revenue will be recognized at the date of the transaction, some will be recognized over. So at the date means the contract date. Over means the terms of the contract. Okay, over the term of the contract. So if I come back to Ohima's contract with MTN Ghana, on the day that Ohima will sign the contract with MTN, what will happen? MTN will give Ohima the iPhone 17 Pro Max. So on that day, at the transaction date, MTN Ghana will recognize a revenue of the amount allocated to the iPhone 17 Pro Max, 5,885 Ghana cedi. Yeah, that's revenue to be recognized. But MTN has not received any money yet. You are right. You are right. So the journal entry for that is to debit contract receivable and then you credit revenue. That's the journal entry for that. So at the date of the transaction, boom, we recognize revenue. MTN will recognize revenue because the iPhone has been given to Ohima. Then the internet service cost, which is the 3115 that we got here, is going to be spread over 36 months. So 3115 divided by 36. So every month, they will be recognizing a revenue of 87 approximately. But remember monthly amounts that Ohima will pay, we said 250. So the monthly amount Ohima is paying is 250. When MTN receives that 250 every month or receivable from Ohima, that 250 will be divided into 2. The 315 or 3115 divided by 36 in Ghana cedis. So every month, when they receive the 250 from Ohima, they will recognize a revenue of 87 Ghana cedi. Sounds good? The remaining amount will be written off against the contract receivable, the iPhone that we recognized earlier. Because this 35885 will also be divided by 36 months. So 5885 divided by 36, and that's about 16, maybe 3. So contract receivable would take the difference of 163. So the monthly payment that Ohima will make, the journal entry will be debit cash of 250, credit revenue of 87, and then you credit the contract receivable 163. So over the life of by the end of the 36 months, the contract receivable, which related to the iPhone that was given to Ohima, would have been written to 0. This is the 5-step framework for revenue recognition. You see that it's very easy. Very, very nice. Very, very simple. Any questions for me? Any questions for me? Let me know if you have any other questions. Okay, so I'm seeing a question coming up from here. So that's basically IFRS 15, the revenue part. Timothy said, what? That's also business with related parties. Or, oh, in what context are you taking on him? Yeah, if the business is with related party and we are not getting any money from it, then we won't apply IFRS 15, right? But then, in accordance with IAS 24, related party transactions, we must make disclosures in the notes to the financial statement. So, if it is a related party transaction and we are not getting any revenue, that's okay. IFRS 15 will not apply. But IAS 24 will come to town. So, in that case, to enhance faithful representation of the financial statement, we must disclose in the note that, during the year, there were some transactions that occurred between Nhyira Premium and Kukua, and they are related parties, so there was no cash. That is to enhance the faithful representation of the financial statement. So you are right. If it is a related party transaction, we apply the IAS 24, and no money came in the deal, then IFRS 15, it's not going to be coming to town. What else we got? Let me see. Give me a moment. I'm trying to bring up the chat from here. Okay, but basically these are the things that you must understand when we talk about these standards issues. And if you look at it, you realize that, yes, the accounting standards are interesting. They are not difficult. So that is the answer to our question here, the 5-step framework. So you are speaking English. Briefly, you explain all of the 5-step framework. Okay. So identify contract with customer or customers. Briefly. Step 2, performance obligation, transaction price, allocation, and then you recognize revenue as and when it's recognized. So as and when performance obligation is satisfied. So that's all. Here you are just writing English. Boom, you are done. But as I said, because I'm in class, that's why I walk you through the example so that you understand the 5-step framework and how the accounting actually applies generally at the end of the day. So that's it about that there. Any other questions for me? Let's see. Okay. So I'm going to wrap up around here today for our discussion. And God willing, we'll come back on your way. We'll come back your way as we continue with the discussion. As I mentioned, in case you want to get access to more practice questions like this on each of the topical areas, please send us a message on WhatsApp 050-114-9296. And you'll be guided, or visit our website to check out our full practice question courses so you can prepare well for the examination, because exposure is very important. Alternatively, if you want to join our live lectures and get access to our courses, content, everything, studying under my mentorship, joining our live lectures as well, certainly that is also available. And if you're preparing for the March 2026 examination, certainly you can join and get access to these contents, studying under my mentorship as we help you to go into the exam or write the exam with confidence and pass the examination. Please remember, we have these contents also available on various other platforms. So wherever you get your podcast, just search for Nhyira Premium, wherever you get your podcast, either Spotify, Amazon, Apple Podcast, wherever you are, just search for Nhyira Premium and the podcast will come. You can get an audio version of various content as well available on our podcast to help you to really be in a better position emotionally, spiritually, mentally, so that you can go to the exam or write the exam with confidence and pass the examination. So once again, Happy New Year, and I'm wishing you all the best this year. If your New Year resolution is to become a chartered accountant this year, it means you have started working on that New Year resolution. Janie, you will sit around before you see October 2026. Then you've not done anything yet. So If it is part of your New Year resolution to become a chartered accountant this year, which is possible because you can write exam in March, write exam in July, write exam in November. And all other things being equal, irrespective of the number of papers you have from level 2, level 3, if you work hard, you can actually finish this year. Okay? So it's possible for you to achieve that New Year resolution. And let me walk the journey with you and assist you, help you, so that you can really pass the examination and become successful. So thanks for watching, and I'll see you on the next one as we continue with our discussion. Stay safe and have a great weekend. Bye-bye.